In this video, we're going to talk about the basics of the stock market and investing. This is meant to be an introductory video where you learn about some basic financial principles and how exactly does the stock market work. There's many different terms and definitions along the way, so feel free to skip ahead to the timestamp that interests you the most. If you're a complete beginner though, I recommend you watch the video from start to finish. If you're new here, my name is AC. I'm currently a full-time doctor and a finance enthusiast for life. My goal is to simply help you get more comfortable with your money. And just as a caveat, I'm not a financial advisor. This information is for educational purposes only. Number one, what exactly is the stock market? A stock market, also known as a stock exchange, is simply a giant marketplace. Think about it like eBay. It's simply a marketplace where you can buy and sell things, and in this case, it just happens to be shares of publicly held companies. Unlike eBay though, the prices are dynamic. They can change on a week-to-week basis and sometimes even a day-to-day basis. The stock market also has normal hours of operations. It's open between Monday to Friday, 9:30 a.m. to 4 p.m. Eastern Time. It's also closed on the weekends and on most major holidays. To note though, crypto is completely separate from the stock market and it can actually trade 24/7, including on the weekends. The two biggest stock exchanges in the United States are the NYSE and the NASDAQ. There are over 2,800 companies on the NYSE and 3,300 companies on the NASDAQ. Number two, what exactly is a stock? A stock, also known as a share, is simply part ownership of a company. Let's simplify this a little bit though. Imagine there was a local pizza shop and the shop owner wanted to take on investors. The shop owner could theoretically split up the company into small pieces. Let's say he divided his company up into 100 equal pieces. If you wanted to be a part owner of the company, all you would have to do is buy shares of that company. So if you bought 10 shares, then theoretically you'd be 10% owner of the pizza shop and you'd be entitled to 10% of the profits and losses of that business. Let's scale this up a little bit. Apple is the most valuable company in the world and there are currently 15,599,434,000 total shares. These total shares are also known as the outstanding shares. At the time of recording this video, Apple's share price is approximately $171. In order to calculate the total value of the company, you have to take the individual price of each stock and multiply it by the number of stocks available. This calculation is also known as a market cap, and it's the easiest way to compare companies in terms of size and value. So if you multiply 15.6 billion times $171, you get approximately $2.64 trillion. This is the total worth of Apple at this moment in time. Number three, what are the benefits of owning stock? There's two main benefits in owning stock. You as a shareholder are entitled to a portion of the profits, and as the company grows in value, the price of your stock will also go up. That first benefit I mentioned of profit sharing is also known as a dividend. At the end of each quarter, a company will release a report known as an earnings report. In this report, they'll share many financial details such as what was their total revenue, what was their total cost, and ultimately what was their total profit for the quarter. They also have something known as guidance, which gives investors an idea of which direction the company is going. Companies are not required to share their profit, by the way. Certain companies will share more of their profits than others. For example, one of the companies with the highest dividend is ExxonMobil. They share 4% of their profit on an annual basis. Compare that to a company like Apple that only shares 0.56% in dividends. So does this mean that ExxonMobil is a better investment than Apple? Well, that's not necessarily the case. If you only looked at the dividend, then surely ExxonMobil would win out. Apple's share price was $20 10 years ago, and today it's $171. So if you invested $1,000 into Apple 10 years ago, in today's dollars, it would be worth approximately $8,500. ExxonMobil, on the other hand, their share price 10 years ago was $86, and today it's only $108. So if you invested $1,000 in ExxonMobil 10 years ago, today it would be worth approximately $1,250. And if you include the $40 dividend every year, that brings another $400 in dividend for a grand total of $1,650. So when you compare Apple to ExxonMobil, Apple was actually a 5 times better investment than ExxonMobil if you look at the full picture. As you can see here, dividends are not the only thing that matters, and the overall growth of the company often matters even more. Stocks with high dividends are also known as blue chip stocks or value stocks. They often have high dividends because they're stable, but they don't necessarily have high growth potential. Other stocks like Apple, where they have a much higher growth potential, they're aptly named to be called growth stocks, and these are deemed to be riskier investments, but they have a much higher upside. Number four, what is an IPO? An IPO is also known as an initial public offering. Now, you might be wondering, why on earth would companies want to share their profits with the public? Shouldn't they want to keep those profits to themselves? I'm sure you've all watched Shark Tank before, and this is exactly what's going on a larger scale. Companies will offer a portion of their company. In return, they get some capital, and they also get investors to help grow the company faster. Prior to an IPO, companies are private, and they don't have to share any of their financials or their profits or any information with the public. In order for a company to undergo an IPO, there are many rigorous standards that they must meet in order to protect investors. Number 5, what is a broker? Let's say you've made up your mind and you want to invest in some stocks. The stock market is a public marketplace, but individuals cannot simply register and trade stocks on the exchange. The stock exchange is heavily regulated, and only individuals or firms who are registered with the exchange can trade on the marketplace. The SEC is the government agency that regulates the stock market. Back in the 90s, brokers used to charge extra high fees, and it wasn't uncommon for 5% of your transaction just to be eaten up in fees alone. Compare that to today, where you can trade for free or even pennies on the dollar. It's much easier to place trades. Some of the most common brokers include things like Vanguard, Fidelity, Interactive Brokers, Thinkorswim, TradeStation, Webull, Robinhood, and the list goes on and on. The choice of a broker is very important, but it can depend on a lot of different factors. It really comes down to, are you a trader or are you an investor? For things like short-term trading, maybe Webull or Robinhood might be better for you, but for long-term investments and retirement accounts, Fidelity, Charles Schwab, and Vanguard are probably safer choices. Number 6, what does it mean to go long or short? You might have overheard investors or traders talking about going long or short the market, but what exactly does that mean? In general, there's 3 things that the stock market can do. The stock market can go up, the stock market can go down, or the stock market can trade sideways. When an investor or trader thinks the stock price will go up, they'll buy shares of the company and hope to profit in the upswing. On the other hand, if they think the price of a stock is actually going down, they can actually sell that company and profit as it goes down in price. This is known as short selling. Let's use an iPhone as an example. Imagine you bought a new iPhone for $1,000. You know that in 1 year, that new iPhone is only going to be worth $800. In this scenario, you could sell the iPhone for $1,000 and buy it back for $800. In this case, you've made a profit of $200. This is a very simplified way of looking at short selling, and it's a little bit more complicated, but if you're interested, leave a comment and I'll make a full video. As far as long-term investment goes, most of your portfolio is going to be long, and most of the time, no one has any short positions in their portfolio. If you want to learn more about hedging your portfolio with puts or covered calls, leave a comment and I'll make a full video. Number 7, what is a bull market and what is a bear market? In the investing world, bulls and bears are frequently used to refer to market conditions. In a bull market, the general economic factors are positive and the overall stock market as a whole is growing. Bull markets are characterized by investor confidence, economic growth, and rising employment rates. A bear market, on the other hand, represents negative economic factors or other events that make it unfavorable to grow. The technical definition of a bear market is when the market has dropped 20% from recent highs. It's a given that the stock market will go through periods of highs and lows. There will be periods when the stock market rises, and there will be periods when the stock market falls. The last significant bear market we saw was in 2020. Between February and April of 2020, the stock market sold off approximately 40% of its value. This graph represents bull and bear markets a little bit differently. It represents the length of time in which we're experiencing a bull market or a bear market. As you can see, most bear markets are short-lived, and they're often followed with a strong bull market in recovery. Number 8, what influences stock prices? This is a very complicated question, and there's many factors that determine the stock price of a company. There's both company-specific factors and market-specific factors that determine a stock price. In a perfectly efficient stock market, prices would be perfectly matched to the true value of the company at all times. 2 of the most common ways to evaluate a stock are to look at their EPS and their PE ratio. EPS is calculated by taking the company's net profit and dividing it by the number of outstanding shares in the company. The PE ratio is a derivative of EPS, and it takes the stock price and divides it by the EPS. In general, both are indicators of how profitable a company is relative to their share price. The absolute PE ratio is important, but so are the general trends. Also, it's important to note that stocks in different sectors will have different ratios. This graph here sorts the PE ratio by sector. As you can see here, sectors like real estate and tech trade at much higher PE ratios compared to things like utility and energy. So far, we've talked a lot about company-specific factors, but we haven't talked about market-specific factors. Inflation, interest rates, market sentiment, and global news are all important variables. For example, during the COVID pandemic, there was too much uncertainty and there were also supply chain problems. In addition, when the Fed was rapidly increasing interest rates, it caused a short sell-off because companies didn't have access to as much cash. This affected their earnings and thus their stock price. We've covered a lot of information at this point, and you might be asking yourself at this point, how on earth am I going to choose the right stock to invest in? Don't fret though, even professionals have difficulty beating the benchmark. In 2008, Warren Buffett famously challenged the hedge fund industry that they would not be able to beat this benchmark. After 9 years, the results were remarkable. The index fund had grown 85%, and the average hedge fund growth was only 22%. This is actually great news for the average investor. There's no need to pick individual stocks. All you have to do is pick the right benchmark and see your portfolio grow over time. The benchmark that Warren Buffett was referring to was called the S&P 500. The S&P 500 is an index fund. And to take a step back, an index fund is simply a collection of stocks. Instead of having to choose individual stocks yourself, these stocks are automatically compiled into a basket and you're able to buy that basket at once. Imagine you needed to go to the grocery store to buy apples, grapes, bananas, and other fruits. Instead of having to pick individual fruit and pick the very best one of each category, you can buy a gift basket instead and buy it all pre-assembled. The beauty of the S&P 500 is that it takes the guesswork completely out. In addition, you get automatic diversification because there's 11 different sectors that make up the index. These include technology, healthcare, financials, real estate, energy, materials, consumer discretionary, industrials, utilities, and communications. In the long run, the S&P 500 has grown 7-10% every year. This doesn't mean that your portfolio will go up every single day though. There will be periods when stocks are dipping, and that's okay. These are the moments to actually buy more. We covered a lot of information in this video, and if you made it this far, thank you and congratulations. If something doesn't make sense, leave a comment and we'll figure it out together. If you're interested in trading versus investing or how to read a stock chart better, you can check out one of my other 2 videos here. Anyways, I hope you have a great day. I'll see you next time. Peace, guys.